Thanks for joining us on the show, everyone. The central bank has just sent one of its strongest messages yet to Nigeria's financial sector. 46 microfinance banks have lost their licenses in one sweep. The CBN says they failed basic regulatory tests, from inadequate capital and weak balance sheets to abandoning operations without approval. It insists the action is about protecting depositors and restoring confidence in the financial system. But it also raises bigger questions like just how healthy is Nigeria's banking sector beneath the surface? Are these isolated failures or signs of something deeper? And as banks scramble to meet tougher capital requirements, I think we had that happen earlier on. The big question will be whether or not we're entering another wave of consolidation. The recent merger between Providus Bank and Unity Bank suggests the industry's landscape is already changing. So is this the beginning of a stronger banking system or simply survival of the fittest? I'm joined by someone who understands these issues from inside. Mayowa Amoo is founder and CEO of QLP. He previously led mergers and acquisitions at UBA and served on the bank's executive committee. Mr. Amoo, welcome to Beyond the Headlines.
Good evening, Nifemi. Thank you for having me.
Glad to have you come. 46 licenses revoked at once. Is this a sign that the banking system is in trouble or proof the regulator is doing its job?
My view is really that the CBN is just doing a cleanup, really. If you went ahead as a bank to procure a license and you met the initial regulatory requirement, I think what some of our entrepreneurs fail to bear in mind is that once you get the license, you usually need a bit of time to convert that license into profitability. So you would run the business for maybe 1, 2, 3 years before you start making real money. And over the 2-3 year period, while you're trying to get your feet solid on the ground and serve your clients and investing in all the infrastructure you need to be able to run a successful bank, you will be eroding your capital. So when you make losses, you are eroding your capital. And the expectation of the regulator is that there's a minimum regulatory capital you must maintain regardless of how your operations are going. So one of the tests that CBN must have carried out is, are these microfinance banks compliant with the minimum regulatory requirement? I think going forward, the advice to entrepreneurs that want to do indeed any kind of business, especially a regulated business, is the regulated capital is one thing, the economic capital is another. So if you wanted to start a bank and the regulatory capital is $1 billion, you should probably get ready for $2 billion, because you would run losses for the first few years, and so that you do not then become liable to infraction, you need to make sure you have surplus over the period. So I think that's one of the key reasons that the CBN has done this, rather than a systemic problem, really.
You look at that publication, it's citing issues like weak capital that you've mentioned, insolvency, and some other regulatory breaches. But
correct.
Which of these really concerns you the most? What do they tell us about the state of our microfinance sector?
The microfinance sector is in my view, the way I would describe it, is the easiest way to enter the financial services space from a licensing perspective. So if you wanted to set up a microfinance bank in only one location in Nigeria today, your minimum capital requirement is 20 million naira. So the entry really is, the barrier is not very high. For that reason, what you will find is that that part of the industry that is meant to really cater to what you may call the bottom 100 is highly fragmented, because there's just so many players, but only a handful doing real meaningful business. So what the CBN is trying to do is to rather than, if you like, announce a recapitalization of that segment of the market, wield the big stick and say, you've not been compliant, give us our licenses back. It's also maybe a signal for those who are left to get their acts together and maybe think about snapping up the weaker ones that are still within the system post this revocation. So maybe a wave of mergers and acquisitions in that space. But it's not very common to find microfinance banks merging like you would have in the normal tier 1, tier 2 segment of the industry.
For customers whose bank is on that list, what happens next? Is their money safe?
Indeed, the money is safe. The CBN could either wind down the banks, in which case depositors' monies will be refunded. I think it's also important to mention that the insurer for the financial services space, the NDIC, also covers depositors' funds within the microfinance banks. So to your question, depositors' funds are safe, correct.
Do they need to do anything specifically?
I think in terms of next steps, that will be up to the CBN to come up with a framework for the modalities for returning depositors' funds, if that's the route that the CBN chooses to take. Because the CBN may also decide to offer some of these microfinance banks on a negotiated basis to the stronger players in that space. And that way, automatically, if any of such private bilateral conversations work, then the customers automatically become customers of the new acquire microfinance banks under such arrangements.
You know, microfinance banks were created to serve small businesses and people excluded from traditional banking. Could shutting down so many for the 6 institutions at once, in a way, end up hurting financial inclusion?
If you ask me, I think the strategy of the agent network to include or to improve financial inclusion has been a lot more successful than the microfinance banks. Although there are linkages between these microfinance banks and the agent network. By agent network, I mean the POS operators in our neighborhoods across the country, where you can do your basic transactions. So to respond directly to your question, my view is not as much. I think the CBN has achieved quite some significant milestones as far as financial inclusion in the country is concerned.
Some observers believe that banks today are operating in a tough economy, high interest rates, stubborn inflation, weaker consumer spending, if you like. How much of these failures is poor management and how much is simply the economy?
You know, when you run any business, there are factors you can control and there are factors you can't control. The big banks have a lot more resilience than the smaller ones, for sure. Regardless of the economic challenges, which in my view are temporary and improving, the macro policies were very necessary. The responsibility of bank management is to be as proactive as possible and anticipate policy direction. And where that is not the case, have the capacity to respond quickly if you're caught by surprise, and have measures of resilience to make sure that the impact will be as minimal as possible. I think in the midst of the current macroeconomic flux, if you like, some sectors are doing well. Exports are doing well. Many banks are beginning now to focus on how financing can be made available to exporters, because our balance of trade is positive and has been for perhaps a couple of quarters now, if I'm not mistaken. So it's just important to pick and choose where and how to respond to make sure that sustainability remains paramount.
I'd like us to quickly touch on the recapitalization exercise, which I think is behind us now. What has it actually achieved? Should Nigerians expect stronger lending to businesses and the real economy, or will banks simply emerge bigger without becoming more impactful?
When you raise capital, that's more cash in the system for lending. That improves the capacity of the banks to lend. That improves the capacity of the banks to borrow more money, for instance, from development finance institutions to lend. So ordinarily, there should be credit expansion, because really that's the core mandate of the banks. What we must not lose sight of is that banks, no matter the state of liquidity, will not be irresponsible in their credit choices. It is up to entrepreneurs, business owners across all sectors of the economy to present bankable transactions, bankable deals, bankable opportunities for the financial institutions to consider to back. Without that, if the credit checks are not ticked off, no bank worth its name will advance credit. So to respond directly, yes, in principle, the banks are able better to lend to improve the economic fortunes of the country.
So this credit expansion is not something we can realistically expect in a short time, right?
There's usually a lag, between policy implementation and the impact you will see in the economy. But I would say in the next 6 to 12, 18 months, the impact should be felt. We must also bear in mind, though, that we're in the middle of an election cycle, and that has a way of sort of slowing things down a little bit because investors, including some banks, rightly so, will adopt a wait-and-see approach in terms of the outcome and success of the elections.
Do you think the post-recapitalization era will naturally produce more mergers and acquisitions as banks continue to look for scale, some form of efficiency and market share?
Providus unit you mentioned is an example of a recent merger. Maybe there's one or two others, but this recapitalization exercise did not trigger the kind of wave of M&A that we saw in 2004 under Professor Soludo. Regardless of the success of this capitalization, it doesn't foreclose the possibility of having mergers and acquisitions still. As a matter of fact, there are 2 exposure drafts in the market right now, pending comments from the public, exposure drafts from the central bank, where potentially there will be another requirement to increase the capital buffer of banks that have adopted the holding company structure. That in itself may trigger acquisitions of banks who may not want to adopt maybe the holdco structure and are willing to merge and offer themselves for the holding company ones. So there's no foreclosure of mergers and acquisitions. Mergers and acquisitions are not only always driven by regulatory intervention. Economic sense usually also determines whether or not business owners, including banks, decide to combine their entities or indeed to sell them off, as the case may be.
Let's stay with the Providus Unity Bank merger for a minute. For customers, should the word merger trigger concern or confidence? What does this deal tell us about where the industry is actually headed?
When you have a merger there's usually a stronger party. And I'm not going to go into which party is stronger or weaker in this case. I'm only mentioning that to respond to your question around whether customers should be confident as a result of the merger. And I think they should. A merger usually strengthens both institutions. But what's important to mention here is that the integration of those entities requires a lot of discipline. There will be hiccups, but those hiccups can be overcome with discipline and proper planning. So again, customers shouldn't have anything to worry about. And the CBN is more than up to the task as far as regulatory oversight of these combinations is concerned.
Mr. Amoo, let's take a short break and we'll be right back to this conversation. Stay with us, everyone. Don't go away.
Thank you very much.
Mayowa Amoo is CEO and founder QLP Capital. He previously led mergers and acquisitions at UBA and served on the bank's executive committee. Mr. Amoo, thank you so much for staying the course on the program this evening. You have advised, indeed, you have advised banks on mergers and acquisitions for years now. In your experience, do banks fail because they run out of capital or because they run out of good governance?
Both are connected. If you have good governance, you would have effective capital monitoring, really. Once governance is properly in place and governance cuts across the people on the board, the policies, the technology enablement, compliance. So it's a mix of governance and making sure that the tone at the top really is right. Recklessness should not be tolerated under any circumstance whatsoever. And I sort of see where you're going with the question. Sometimes when you're awash with cash, you may find that you don't know what to do with it, especially if it's not planned for. But we have an economy and a sector that has been through years of bubbles and busts, and I'm sure the respective shareholders and chairmen and directors on these boards of these banks know what to do to make sure that, most importantly, depositors' funds are safeguarded.
I'd like us to talk about the CBN under Governor Cardoso. We've seen him push recapitalization. We've seen some form of tighter supervision and stronger enforcement. Are we seeing a deliberate shift in the CBN's regulatory philosophy, and do you think it's working?
100% is working. It's working. I remember when Governor Cardoso was first appointed, and his comment was that he was going to restore conservative central banking. One of the ways, in my view, to show it's working, and I've always been a proponent of accretion to the reserves, which is now at an all-time high of above 50 billion US dollars. And I'm hoping that over the next 3 years, that balance will come to $100 billion or more, because cash is king and we're in an import-dependent economy. And once you have that kind of buffer, it gives confidence to entrepreneurs like the Abdusamad Rabius and the Aliko Dangotes and all other industrialists and manufacturing giants that we have in the economy to take big bets because there's confidence. So yes, Mr. Governor of the central bank has taken the central bank, as he should, on a more conservative, traditional approach to central banking, and it is working. And if you wanted to use third-party affirmation for that, recently the Central Bank of Nigeria got an award, I think, as the best central bank institution, if not in the world, but in Africa. And I think that's testament to the kind of work that is going on at that revered, independent institution at the moment.
You know, they say that big banks have been given a run for their money with this new digital banking that we've seen. And they seem to have gotten it so seamlessly that the bigger banks are playing catch up. Is that a redefinition of banking as we know it? And do you see the big banks actually offering the kind of seamless solutions that these other new banks are offering many Nigerians?
Technology is here, I mean, of course, to stay, and it cuts across all segments and all sections of the economy without excluding the financial services space. I think we must not lose sight of the fact that the banks themselves have done quite well. A number of them, without marketing them on your platform, have gone ahead to develop either within their current institutions, full digital banks, or they have created subsidiaries in line with the market demands for full digital service. So yes, maybe they came late to the game, but my view is that they've done quite well in catching up and even exceeding the expectation of market analysts who probably thought that the challenges of running a legacy institution and trying to transit from such a legacy institution to a more modern, digital savvy bank may be more difficult than otherwise. But I think they've done quite well in that regard. What we may also need to bear in mind is that, yes, digitalization is good. Payment service banks are good. But you will also observe that a number of the digital players that started out in the financial services space as payment systems or payment platforms have now gone ahead themselves to take up microfinance banking license or microfinance banking licenses, I beg your pardon. And what's the reason? Having deposits is a competitive advantage. Right, so there's no dismissing the relevance and the sustainability of deposit-taking banks in the financial system.
We have to go now, but 5 years from now, Mr. Amoo, what does Nigeria's banking sector look like? Are we going to see fewer banks, bigger banks, more digital lenders, or simply a stronger financial system?
We will definitely see a stronger, more robust financial system, highly capitalized. We will also see more banks taking up international banking licenses so they can enter the West Africa sub-region and beyond. The remittance space remains still a big opportunity where our local banks are still only earning a small margin of the flows from that segment. So I think in the future, given strong advancements in technology enablement and general payments services, that space also is up for the taking. So in future, Nigerian banks will become bigger and better on the global platform.
Mr. Mayowa Amoo is the CEO and founder of QLP Capital. Thank you so much for joining us on the program this evening.
Nifemi, thank you very much. It's been a pleasure. Thank you.
Well, one thing is clear, everyone. Confidence is the currency of banking, and every regulatory decision must ultimately strengthen public trust. We appreciate your time on the show today. Remember, you can watch it again at midnight and 6 a.m. tomorrow. I am Nifemi Oguntoye.